In this video, I'm going to talk about why the 2026 housing market may not pan out the way that you expect it to. And by the end of the video, I'll break down what the surprise in 2026 is likely going to be for the housing market. So stay tuned. Everyone has a prediction about what they think is going to happen over the next few months, with a lot of people saying that it's overdue for a crash. Others say once mortgage rates fall, prices will explode higher again. And then there's a lot of people that believe we're just stuck and frozen in the current system today. But when you slow down and actually look at what's actually happening in the numbers, then you get a better picture of what to expect this year. For example, when you look at inventory trends, builder behavior, mortgage rate dynamics, investor activity, and buyer psychology, the 2026 housing market is not lining up the way most people expect it to. It's certainly not setting up for a clean crash, and it's certainly not setting up for a clear boom. It's setting up for something much more complicated. And depending on where you live, that complexity could feel like a surprise. So let's walk through what's actually happening under the surface. Right now, there are three dominant narratives around housing. First, when mortgage rates fall, affordability improves, and then buyers will rush back, which will then cause prices to surge again. This is the rate unlock theory. Narrative 2, the economy slows, which leads to unemployment rising, which leads to forced housing sales, and then that would lead to prices declining. That's the delayed recession crash theory. Narrative 3, rates stay high, sellers remain in their homes, and buyers are still unable to buy. That means the market will stay frozen. No crash, no boom, just stagnation. So each of these stories has some logic behind it. But here, let's talk about the problem. Housing doesn't move based on one lever. It moves based on the interaction between credit conditions, supply flow, construction pipelines, investor behavior, and human psychology. And right now, those forces are pulling in different directions entirely. And that's what makes 2026 different. See, inventory isn't what it used to be. For years, we've been told one thing. There's a massive housing shortage. And that's true. We're short about 7 million homes according to HUD. But the type of shortage has shifted. Let's break this down into two categories. First, existing home inventory. Most homeowners refinanced or bought between 2020 and 2022 at historically low rates. They've got 2%, 3%, 3.5% mortgage interest rates. So if you own a home at 3% and today's rates are 6 or 7%, you're not moving unless you absolutely have to. That created what we call the lock-in effect. And that lock-in is still very real. So resale inventory remains constrained in many markets. But here's where things change a little bit. Builders didn't stop building houses. In fact, many markets, they accelerated. Now you might wonder why. Because they can control pricing more flexibly than individual sellers. And they can offer rate buydowns, incentives, closing cost credits, and free upgrades, which is something we've seen them doing over recent months and years. They can effectively cut prices without actually cutting the price. And that's very different than what happened in 2008. So what are we seeing? We're seeing a split inventory market. Resales are tight, new construction is more competitive, and that fragmentation matters for this year's market. Now here's one big assumption that most people are making. If rates fall, prices will surge. That sounds intuitive. Lower borrowing costs means buyers qualify for more. But that's only half of the equation. Because lower rates don't just unlock buyers, they also unlock sellers. So imagine rates drop into the low 5%. Suddenly, homeowners sitting at 3% mortgages aren't facing doubling of payments anymore. They may move, they may downsize, they may relocate, and that increases resale supply. So instead of lower rates moving to bidding wars, it could mean that lower rates lead to more listings, which would lead to competition spreading out, and then price growth would be moderate. This is why 2026 may not look like 2021, even if rates drop. The lock-in effect doesn't disappear overnight, but it does soften, and even a modest increase in listings change leverage. Another major difference heading into 2026 is large public home builders are financially stronger than they were in past cycles. They have stronger balance sheets, land pipelines, flexible financing tools, and institutional capital backings. If demand slows, they can reduce building. If demand rises, they can ramp up building. That creates a more stabilizing force. They aren't forced sellers in the same way distressed homeowners were in 2008. They can manage production, and that reduces the odds of a dramatic collapse. At the same time, they're motivated to move inventory, which creates downward pressure on margins before it creates downward pressure on headline prices. That is important. We also can't ignore institutional investors. In many markets, large investors buy build-to-rent communities, acquire properties during slowdowns, or step in when prices soften. So even if individual buyers pull back, capital doesn't just disappear. That changes the volatility. It doesn't eliminate risk, but it does reduce the probability of widespread collapse. Now let's talk about the psychology shift. Housing isn't purely economic. It's also emotional, and psychology has been frozen for a few years now. Buyers have just been waiting for prices to fall, rates to drop, and a crash to finally happen. But if neither crash nor boom materializes, psychology may shift toward acceptance. Instead of saying, I'll wait for the perfect moment, it becomes, this is just how it is now. That shift stabilizes prices faster than most of you would expect, and it tends to happen quietly. You don't see big headlines around talking about this. So here's what the surprise in 2026 may be. Here's the likely surprise. It's not a nationwide crash, it's not a dramatic boom, but it's a regional split. Some markets will soften, some will stabilize, and some will see appreciation. New construction will compete aggressively, and resale inventory will gradually improve if rates ease. The affordability will improve slowly, but not dramatically. But the biggest surprise is the absence of drama, because after years of extremes, the 2026 housing market is going to feel a lot more controlled. It's going to be messy, fragmented, but not explosive. So the 2026 housing market is not lining up for a clean headline. It's setting up for a lot of nuance. There's going to be regional divergence and gradual shifts instead of sudden shock. So if you're trying to decide whether to buy, sell, or wait, the right move may depend less on national narratives and more on local inventory, your financing options, and your own personal timeline. Because housing rarely surprises everyone in the same way. But 2026 may surprise people in a very different way, depending on where you stand.